Three numbers, just three. $4,600. The current price of 1 ounce of gold as of May 2026, up from $2,600 just 18 months ago. $36 trillion. The United States national debt right now, growing by roughly $1 trillion every 100 days, 56.9%. The dollar's current share of global reserves. The lowest it has been since 1995. Now here's what nobody is telling you. These three numbers are not separate stories. They are three symptoms of one thing happening right now, a fundamental restructuring of the global money system. Not a crash, not a conspiracy theory. A deliberate, policy-driven reset, the same kind that happened in 1944 and again in 1971. Both times it happened before. The people who understood what was shifting walked away significantly wealthier. The people who didn't lost quietly, slowly, without ever fully understanding why. We are at the early stages of the third reset, and the window to position yourself correctly is still open. Today I'm going to show you exactly what's happening, why it's happening, and the three specific moves that protect your money while everyone else is still confused. Act 1. How we got here. You cannot understand where this is going until you understand how it was built. Go back to 1944. World War II is winding down. Europe is in ruins. The entire global economy is shattered and needs to be rebuilt from scratch. 44 countries send representatives to a small hotel in Bretton Woods, New Hampshire. Their job, redesign the global financial system. The deal they struck was elegant in its simplicity. Every country's currency would be tied to the US dollar, and the US dollar would be tied to gold, at exactly $35 per ounce. This gave the entire world a stable, trusted foundation. It launched the IMF and World Bank. It made New York the financial capital of the planet. And it powered the greatest economic expansion in human history, highways, a middle class, decades of genuine prosperity. But a flaw was baked in from day one. An economist named Robert Triffin identified it in 1960. He called it the Triffin dilemma. Here's the problem. If the US dollar is the world's reserve currency, America has to supply enough dollars for the entire world to use in trade. But to supply that many dollars, America has to spend more than it earns, running permanent trade deficits. And if it permanently spends more than it earns, eventually the world starts asking whether those dollars are actually worth anything. By the late 1960s, that question had arrived. The US was funding the Vietnam War, expanding domestic programs and printing dollars faster than it had gold to back them. France, always skeptical of American financial dominance, literally sent a warship to New York Harbor to collect their gold. Other countries followed. So in August 1971, President Nixon went on television and made an announcement that changed everything. The dollar would no longer be convertible to gold. Just like that, the Bretton Woods system was over. The dollar was now backed by one thing only, trust in the United States government. Act 2. The flaw becomes a crisis. What Nixon did in 1971 set a timer. In 2026 that timer is running out. Once the dollar had no gold backing, there was nothing stopping the government from printing more of it. And they did. Every financial crisis, 2001, 2008, 2020, the response was identical. Print money, lower rates, flood the system with dollars. The total US money supply went from roughly $600 billion in 1971 to over $21 trillion today. That is not growth. That is dilution. Every dollar you hold becomes worth less than it was yesterday, because there are simply more of them chasing the same amount of real things in the world. And here is the part that should genuinely make you angry. This is not a bug. This is a feature. Inflation is a hidden tax. It silently transfers wealth from people who hold cash and earn salaries to people who own assets, real estate, stocks, gold. If you've ever wondered why the gap between the wealthy and everyone else keeps widening year after year, this mechanism is a significant part of the answer. The rich own things. Their things rise in value as more money gets printed. Everyone else's savings quietly disappear. Now fast forward to today. Central banks worldwide are orchestrating the most significant reserve diversification in modern history, accumulating gold at unprecedented levels, while systematically reducing their exposure to dollar-denominated assets. Over the past 2 decades, the share of global foreign exchange reserves held in US dollars has declined from roughly 71% in 2001 to approximately 58% by recent measures. And all 3 major US credit rating agencies have now downgraded American debt. The world has noticed. Act 3. 3 signals you cannot ignore. These are not predictions. They are things already happening right now. Signal 1. Gold. Central banks across the globe have transitioned from traditional reserve management to a gold-first strategy, effectively turning official sector demand into a permanent structural pillar of the bullion market. Think about what that actually means. The institutions that print money are buying something that isn't money. That is a very specific kind of signal. Gold prices surged by 55% in 2025 and surpassed $4,000 per ounce for the first time in October, driven by trade concerns, reduced demand for the US dollar, and increased central bank buying. JP Morgan's most recent forecast sees gold reaching $6,000 to $6,300 per troy ounce by the end of 2026. Goldman Sachs has a $5,400 target. Deutsche Bank at $6,000. UBS with an upside case of $7,200. These dollars are not fringe analysts making wild predictions. These are the largest financial institutions on the planet, and they are all saying the same thing. Signal 2, the dollar's declining share. Russia and China now settle around 90% of their bilateral trade in rubles and yuan. BRICS de-dollarization efforts in 2026 are pushing forward with alternative payment systems. The BRICS Pay expansion has engineered connections across Russia's SPFS, China's CIPS, and India's UPI. BRICS payment system, built on interoperable central bank digital currencies, is a crucial agenda item at the upcoming BRICS summit. Now, important nuance here. The dollar is not dying tomorrow. There appears to be no viable alternative to the dollar as of yet. The US Treasury market remains the world's deepest and most liquid sovereign debt market. But here is what matters. The trajectory is more important than the current level. A dollar that commanded 72% of global reserves in 2001 now commands 56.9%. That is not a collapse. That is a slow, structural, deliberate shift. And slow shifts are the most dangerous ones because most people don't notice them until it's too late. Signal 3, the policy response. Here is where this gets genuinely interesting, because the reset is not just being driven by other countries pushing back on the dollar. It is also being actively engineered from inside the United States. Treasury Secretary Scott Bessent has explicitly called for a Bretton Woods-style realignment, a fundamental restructuring of the global financial system for a multipolar world. The administration's strategy involves deliberately weakening the dollar to make American exports competitive again, using tariffs as leverage to bring manufacturing back to US soil. The gradual dollar depreciation expected through 2026 will ripple through portfolios in ways most investors haven't considered. USD-denominated assets face headwinds. This is not an accident. This is a plan. The question is whether you're positioned before it fully plays out, or after. Act 4, 2 scenarios. History says the truth lands somewhere between the optimists and the pessimists. Scenario 1, managed transition. The dollar weakens gradually over several years. Trade deals get renegotiated. Some manufacturing returns. Inflation stays elevated but controllable. Asset prices, gold, real estate, domestic industrial stocks continue rising. The people who positioned correctly build real wealth through the transition. Scenario 2, something breaks. Currency volatility accelerates. A major economy hits a debt crisis. Inflation surges faster than the Fed can respond. Markets reprice sharply. The world losing trust in the US dollar has become an increasingly visible trend that amplifies each of these risk channels simultaneously. In this scenario, prepared people come out ahead. Everyone holding unhedged cash portfolios does not. History says neither scenario plays out cleanly. The transition will be messier than optimists expect, and less catastrophic than pessimists predict. The question is not whether something changes, it already is. The question is whether you move before it fully arrives or after. Act 5, 3 practical moves, not theory, not predictions. Specific things you can do this week. Move 1, escape the cash trap. If your savings are sitting in a bank account right now, here is what is actually happening. Inflation is running well above most savings account interest rates, which means in real purchasing power terms, your account balance is shrinking every single year, even when the number on screen goes up slightly. Holding cash in 2026 is not playing it safe. It is a slow, guaranteed path to losing ground. Move 2, diversify beyond dollar-only assets. If your entire portfolio is US dollar denominated, you have a specific concentration risk right now. Here is the nuance most people miss though. The largest US companies, Apple, Microsoft, Google, already earn 40 to 50% of their revenues outside the United States in foreign currencies. When the dollar weakens, those foreign revenues translate back into more dollars. You are not as purely dollar exposed as you think if you own the right companies. Understanding what you own and where its revenue actually comes from is more important right now than it has been in years. Move 3, understand what gold actually is. Gold is not an investment in the traditional sense. It is insurance. You do not buy car insurance because you want to crash your car. You buy it because if something goes wrong, you are protected. This doesn't mean abandoning dollar-denominated assets entirely. It means recognizing the risk and adjusting allocations accordingly. A 5 to 10% allocation to gold, whether physical, ETF, or mining stocks, has historically provided meaningful protection during exactly the kind of monetary transition we are currently inside. Not to get rich on gold, to not get left behind if the dollar's purchasing power falls faster than expected. Here is the honest truth about all of this. The global money system has been reset before. Both times the mechanism was the same, a slow build of structural pressure, followed by a policy decision that changed the rules overnight. Both times the people who understood what was building positioned themselves early. Both times everyone else found out after the fact, and wondered why their savings felt like they had quietly shrunk. We are not predicting a collapse. We are reading the signals that are already visible. The gold price, the reserve share data, the policy statements, the central bank buying patterns. The reset is not coming. No dramatic reset has been officially implemented yet. But the transition is underway through managed decline, de-dollarization initiatives, and digital currency programs rather than sudden systemic overhaul. It is already here. The window to position yourself correctly is still open. The only question is whether you use it. If this changed how you see your money, subscribe. Next video we are breaking down the exact portfolio split. How much in gold? How much in international equities? How much in domestic industrials? For someone starting with $10,000 or less.